For most federal employees, your Thrift Savings Plan or your TSP is the largest bucket of money you might have saved for your retirement. In some unique situations, this might be your only resource for reserves and income, and we will discuss how to think about if you're in this situation. Given the turmoil over the last few weeks about ongoing employment with the federal government, we wanted to share a few thoughts about how to approach your TSP and what concerns need to be kept front and center. In this episode, we will discuss how age and eligibility dictate access to your savings, share our insights on how to think about TSP allocations, and offer some solutions on how to create safety in reserves. And at the end, we'll provide action items. Welcome. I'm Zubin Kapoor, and I'm a financial planner at Valor Wealth Partners, where we are dedicated to educating federal employees on how to maximize value from their complex and often underutilized benefits. But before we get started, I want to let you know that we are hosting a program on the evening of March 13th, where we will answer questions that are most prevalent in people's mind. Please see the link below for details. It is critical for you to understand if the TSP is accessible to you if you lose your job. No matter what, if you're above the age of 59 and a half, you can access your TSP without a penalty. Of course, you have to pay taxes on the traditional portion of your TSP, and the Roth portion of your TSP you can withdraw without taxes. Any monies that is taken out as a distribution is done on a pro rata basis. So what does that mean? If you had $100,000 in your traditional TSP with $50,000 in the G fund and $50,000 in the C fund, so whatever money you withdrew would be taken out half and half from each one of those two funds. If you were able to retire between the ages of 55 and 59 and a half, you could also have similar access to the TSP without a penalty. This is called the rule of 55. For Leos, you can access TSP at the age of 50 without a penalty. Now, with the advent of VERA or DSR, it makes things a bit complicated. So let's assume you are more than 55 years of age and you have more than 20 years of service. Now you are fully eligible to take retirement. And because you're above the age of 55, you can have penalty-free access to the TSP. Now, in another situation, if you're 52 years of age and have 25 years of service, you're fully eligible to retire under under the VERA or the DSR, but you do not have penalty-free access to your TSP until the age of 59 and a half. You can withdraw money from the TSP before 59 and a half. You would just have to ensure that you're aware of the 10% penalty. Whatever you do, don't make any rash decisions on your TSP. There are instances where we have come across where federal employees have been convinced by financial planners that an annuity is the best option for them. And hence think very, very carefully before you sign anything that makes you lose control of your TSP. The other things to keep in mind for accessing your TSP is that you should have a link between your bank or financial institution and the TSP. So once this link is set up, which takes about a week, then you have access to the monies, and if you need them in an emergency, the system is already set up for you to withdraw the money. Otherwise, it is possible that a paper check is mailed to you, and that could take anywhere from 1 to 2 weeks. Let's talk about TSP allocations. It's very hard to give general advice on portfolio allocations. There are many factors to consider, so ensure you take this advice in a general sense. If you have large reserves in a taxable account, say 1 or 2 years worth of funds, you may not need access to your TSP and hence may not have to make any allocation shifts across your funds. Please refer to the video on reserves to get a better understanding on how to calculate your own reserves. Now, if you have minimal reserves and you need access to your TSP quickly, then one would need to look at your allocations. It is possible for you to consider to move your TSP allocations into safer investments so that you're not beholden to the ups and downs of the market. If the crisis passes and hopefully you did not require access to your TSP, then you can go back to the allocation that better mimics your risk profile or what you had originally. If you're doing TSP allocation changes by yourself, it is critical for you to remember to go back and change them to what you had them before. If you're working with a financial planner, then they would work with you to chart the best path forward. Now, if you have minimal to low reserves, then let's examine your LES for options to build up your reserves and generate some cash flow. So the first thing to think about is that if you're putting money into the TSP Roth, you might want to change that to a TSP Traditional. By doing this, of course, you're paying taxes at a later date and you're not paying taxes right away. So this will generate a little bit of cash in your net take-home pay. The other thing to look at is your TSP contribution and the percentage that you're putting away. So in case you're putting away 10% of your income into the TSP, it might make sense to drop that down to 5% so that the other 5% is showing up in your net paycheck and you can build up your reserves. This 5% allows the government to still match your contributions. Now, for those people that might need more reserves, it might be prudent to think about taking down your contribution down to zero. In this case, you will, of course, generate more cash in your net paycheck, but you would not get any contribution from the federal government. Now, as much as this sounds bad, it is better to miss out on, say, a few months of the match from the federal government than incurring long-term credit card debt, which is going to be a lot more expensive. You can also think about taking a hardship withdrawal. This would be a withdrawal for paying medical expenses or if you have negative cash flow. Another option for you to think about is a TSP loan. You could take a TSP loan at a very attractive rate. I think currently it's about 4.1%. And the TSP loan has to be taken while you are still working. You cannot take it after the fact. Again, if you refer to our last video, there were details on how to ensure that you can take a TSP loan properly. Understand how your TSP can work for you and what the rules of accessibility are. Ensure that you are making each decision on your TSP carefully. Take a breath. Examine your TSP allocations and determine if any changes need to be made. If you have to make changes for it to be a little bit safer, go ahead and do it. Don't try to time the market. It's really hard to do. And once the crisis has passed, whether you have taken some money out of the TSP or not, make sure you reallocate your TSP to what better matches your long-term risk profile and goals. And if you need to generate reserves, examine your LES and ensure that you know how to take a loan from your TSP while you're still working. Thank you for watching, and once again, a reminder about the link below for the Q&A session on the evening of March the 13th. Thank you.